Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings. And this week we're diving deep into the Morgan Creek Global Equity Long-Short Institutional Fund. Now, this filing catches my eye because it's not just about numbers, it's about a company deciding to wind down its operations. We're going to break down what that means for investors and look at the financial health leading up to this decision. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss these filings further. This document is a filing from July 2025 and it details a significant decision by Morgan Creek Capital Management LLC, the investment advisor to the Morgan Creek Global Equity Long-Short Institutional Fund. The big news here is that the fund is being liquidated and terminated. This means the fund has officially started the process of closing down and is asking the authorities to deregister it as an investment company. It's been quite a journey for this fund, which started its public offering back in 2011. The exact date of this latest filing is July 28, 2025, and this filing is providing an update on the liquidation process. This filing is a post-effective amendment to their registration statement, specifically Amendment Number 6. And it also marks an update to their Investment Company Act filings Amendment Number 30. The fund offers two main classes of shares, Class A and Class I, each with different fees and expenses, which is pretty standard in the investment world to cater to different investor needs. The fund's goal was to achieve strong long-term returns, similar to the stock market, but with less ups and downs, trying to be less correlated with the overall market. However, with the liquidation, this objective is no longer being pursued. This is a critical change. Instead of actively trying to grow money according to its investment strategy, the fund's sole focus now is selling off its assets to return money to investors. The fund required a pretty substantial initial investment, showing it was targeted at more sophisticated or wealthier investors. This tells us that the decision to liquidate wasn't sudden. The investment manager Morgan Creek Capital Management recommended it, and the fund's board of trustees agreed. This indicates a deliberate move to wind things down. There's a formal plan in place for how this liquidation will happen, which is good for transparency. I've already started giving money back to shareholders, but it's going to take time. This extended period is often due to the nature of the fund's investments, which might not be easy to sell quickly. As expected, during a liquidation process, they've stopped selling new shares, meaning no new money is coming in. This confirms the earlier decision to stop offering to buy back shares from existing investors was also tied to the liquidation plan. Let's look at the financials, specifically the performance. The net asset value, or what each share is worth, started the year at about $542 for Class I shares. By the end of the fiscal year, it dropped to around $475. That's a significant decrease. The total return for Class I shares was a negative 12.26%. This means investors lost over 12% of their money during that year. When you consider the fund is liquidating, this kind of performance might explain some of the reasons behind the decision. The total expenses for Class I shares were also very high, making up a large chunk of the value. This high expense ratio, especially when the fund is already losing value, is a big red flag for investors. It shows that a lot of the money managed is being eaten up by fees. The net asset value per Class A share started at about $477. It fell to around $418. That's also a substantial drop. Class A shares also saw a negative total return of 12.26%. It's interesting that both classes performed almost identically in terms of percentage loss. And again, the expense ratio is quite high at 12.26%. These high fees combined with negative returns can really eat into an investor's capital, especially over the long term. It seems like the fund's strategy wasn't working out as planned, leading to these difficult financial results. The fund itself is described as a non-diversified closed-end management investment company. Being non-diversified means it can invest a larger portion of its assets in a smaller number of companies or investments, which can increase risk, but also potentially increase returns. Their objective was pretty ambitious: beat the market benchmarks when it came to long-term returns, but with less risk and less connection to the market's overall movements. A key part of their strategy involved investing about 80% of their money into other investment funds, often called portfolio funds, that themselves use long-short equity strategies. This fund-of-funds approach means investors indirectly bear costs from both the main fund and the underlying funds. The filing makes it very clear this was a high-risk investment with a real possibility of losing money. This highlights a major risk: illiquidity. Investors couldn't easily sell their shares on a stock market. They had to rely on the fund offering to repurchase them, which wasn't guaranteed. This confirms the structure and regulatory framework of the fund. They tried to blend the flexibility of private investment funds like hedge funds with the structure of a registered company offering access to sophisticated investors. This non-diversified status, while potentially offering higher returns, also means the fund's performance is heavily tied to the success of few investments. If those investments do poorly, the entire fund can suffer significantly. A huge part of the fund's success hinged on the expertise of its advisor, Morgan Creek Capital Management. If the advisor makes poor choices in picking underlying funds or individual securities, the whole fund suffers. Mark W. Yusko is named as the primary portfolio manager responsible for day-to-day decisions. His experience and judgment are clearly central to the fund's strategy. It's worth noting that as of June 2025, the independent trustees didn't own any shares of the advisor or distributor. And importantly, the trustees and officers themselves owned 0 shares of the fund. This sort of detachment can sometimes be a red flag, as it means they don't have personal capital directly at risk in the fund's performance. Looking at who owns the fund, the Roy Cochrane Foundation appears to be a major shareholder in Class I shares, holding nearly 40%. In Class A shares, the J. Fetzing Revocable Trust is the largest shareholder, with over 28%. It's clear there are significant stakes held by a few entities. So what's the story here? Morgan Creek Global Equity Long-Short Institutional Fund aimed for strong returns with managed risk, using a complex fund of funds approach. However, the financial results, particularly the significant drops in net asset value and high expense ratios, especially for Class I shares, suggest the strategy wasn't paying off. The fund's illiquid nature, meaning shares couldn't be easily sold, likely added to the challenges. Ultimately, it appears these performance issues, coupled with the inherent risks of their investment strategy, led to the decision to liquidate the fund. The lack of share ownership by the fund's trustees and officers might be a point of concern for some investors, as it indicates their personal capital wasn't directly tied to the fund's performance. The large holdings by a few shareholders also highlight how a concentrated investor base can influence a fund's direction, and asset-based and high expense ratios, especially for Class I shares, suggest the strategy wasn't paying off. The fund's illiquid nature, meaning shares couldn't be easily sold, likely added to the challenges. In my assessment, the company's diversification strategy through underlying funds, while intended to manage risks, seems to have introduced complexity and increased costs, without delivering the desired returns. The high expense ratios are particularly troubling when combined with the negative performance, suggesting investors were paying a lot for results that ultimately fell short. This is a clear case where the operational structure and investment strategy may not have been sustainable or successful, leading to the inevitable liquidation. The key takeaway for investors is always to scrutinize expense ratios and liquidity terms, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles, especially in funds that invest in other illiquid vehicles. Alright, that's our breakdown of Morgan Creek's filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.